Hi, my name is Alan Porter and my company is Strategic Wealth Strategies. What I want to show you in these next presentations are financial strategies that I've learned in the last 3 to 4 years of constant study. One of the first things I want to show you is the difference between a taxable investment, a tax-qualified investment, and a tax-free investment. So if you transition to my computer, I have my computer and the monitor here, but what I want to show you is I'm treating this all the same. I have $10,000 at 6% interest in a taxable vehicle that's compounding for 20 years. Over here, I've got it at a 33.33% tax bracket to make it simple. So since this is deferred income, where you're going to be paying the taxes later, I have to put $15,000 in. Again, the same 6%. And over here, it's your tax favored investment like permanent life insurance. Again, it's 6% at $10,000. Now, what I want to show you is the difference. And I don't care what anybody ever tells you, but you cannot compound interest in a taxable investment because you've got to pay taxes either from the investment or you've got to pay it from your lifestyle. In this case, I've taken the taxes right out of the investment. So at the end of 20 years, you're going to have $309,692 in your taxable investment. If you look over here in this tax qualified plan, I have a gentleman tell me, well, I've got $584,890. I said, I understand that, but you're in a 33.33% tax bracket, so you have to spend $194,961 in taxes. This leaves you with $389,929. Now keep that in mind because the tax deferred plan and the tax favored plan are the same. They're $389,927. But now what I want to show you is everything is not always the same. Over here in your tax-free investment, we're guaranteed by contract never to have a money loss due to a market downturn. So let's go back over here to your taxable investment. Now if you look here in the 10th year, we've got a 5% loss. The same thing holds true for the qualified money. You have a 5% loss. But since we are guaranteed by contract never to have a money loss due to a market downturn, we have 0. But now let's look at the money. So we go back down here to our taxable vehicle. You have $293,697. When you go back over here to your tax qualified, you've got $363,963. And you go to the tax favored, you're at $375,764. That's just with 1 year of a loss in the stock market. If people don't think taxes are going up, they have a wrong education because we've got an $18 billion deficit and taxes are basically the lowest they've been in years. And I'll show that in another presentation. But if you look down here, again, I have the 5% loss in our taxable vehicle. I have a 5% loss in our qualified vehicle, and I have a 0 loss in our tax-favored investment. But guess what? The government has decided to raise the taxes. We went from 33.33% to 40% in the taxable vehicle. Now we're at 40% in the tax-qualified vehicle. We don't pay taxes in the tax-favored by Internal Revenue Service Codes 7702 and 70E. So now let's take a look at the final figures. So you go down here, your taxable vehicle, you've got $288,504. You go back over here to your tax qualified vehicle, it's $327,565. And guess what? In your tax favored vehicle, it's $375,764. So basically in conclusion, what I wanted to show you is I wanted to show you the difference between taxable vehicle, a qualified vehicle, and a tax-favored vehicle such as permanent life insurance. Again, you cannot compound interest in a taxable vehicle because you've got to pay taxes on it someplace. It's either coming from the account itself or you're going to pay it out of your lifestyle.